If you are claiming Social Security in 2026, pulling an extra $5,000 from your traditional IRA to cover a medical bill could trigger an unexpected federal tax on the fixed income you are already receiving, not a standard income tax on the withdrawal itself. A compounding penalty that drags up to 85% of your Social Security benefits straight into a taxable bracket. Most retirees assume that once they stop working, their Social Security is protected. But under a specific IRS calculation called Provisional Income, sometimes referred to as combined income, your benefits are heavily exposed to how you withdraw your other savings. And right now, millions of middle-class retirees are triggering this calculation entirely by accident. They aren't wealthy. They are simply withdrawing enough money from their 401k to cover rising property taxes, Medicare premiums, and 2026 inflation. But because of a hidden mechanism in the tax code, those standard withdrawals are pushing their Social Security over a threshold that most people don't even know exists until their accountant points it out in April. To understand how this happens, you have to look at the exact formula the IRS uses. The government doesn't just look at the size of your Social Security check, and they don't just look at what you pull from your traditional IRA. They combine them using a very specific, rigid set of rules. Under current 2026 IRS guidelines, to find your provisional income, you take your adjusted gross income. That includes any part-time wages, taxable pensions, and every dollar you withdraw from a tax-deferred account, like a traditional 401k. Next, you add any non-taxable interest, such as income from municipal bonds. And then, the IRS takes exactly 50% of your annual Social Security benefit and adds it to that total. That final number is your provisional income. If you are filing as a single retiree and that number crosses $25,000, up to 50% of your Social Security becomes taxable. If it crosses $34,000, up to 85% becomes taxable. For married couples filing jointly, the first threshold sits at $32,000. The second tier, where the 85% penalty kicks in, is just $44,000. Think about those numbers for a moment. $44,000 in combined income for a married couple. In today's economy, generating $44,000 of income in retirement does not mean you are living a lavish lifestyle. For many couples, that amount barely covers baseline living expenses, especially when factoring in the current costs of healthcare and housing. But according to the federal government, crossing that $44,000 line categorizes you as wealthy enough to have the vast majority of your Social Security subjected to federal income tax. There is a historical reason for this disconnect, and it explains why this issue is hitting retirees harder today than ever before. These income limits were not created recently. The first tier was written into law in 1984. The second tier was added in 1993. Back in the 80s and early 90s, $32,000 or $44,000 in pure retirement income meant you were doing exceptionally well. The tax was specifically designed to target the richest retirees in the country while completely protecting the middle class. But Congress left out one critical detail. Unlike standard tax brackets, which are automatically adjusted for inflation every single year to protect your purchasing power, these provisional income thresholds were frozen in time. They were never indexed for inflation. They have not been updated in over 3 decades. Meanwhile, the cost of living has surged. To survive, retirees have been forced to withdraw more money from their savings. And every time Social Security issues a cost of living adjustment to help you keep up with grocery bills, your gross benefit goes up. But the tax limits stay exactly the same. This creates a silent trap. Inflation forces your nominal income higher just to maintain the exact same standard of living. But as your nominal income rises, it pushes you past those frozen 1,984 thresholds. A tax designed for the wealthy has slowly, mechanically crept down to swallow the middle class. Let's look at a realistic scenario of how this actually plays out at the kitchen table. Take a married couple. In 2026, they collect a combined $3,000 a month from Social Security. That comes out to $36,000 a year. According to the IRS formula, we take half of that. So, their starting point for provisional income is $18,000. Now, this couple needs to pay their bills. Between Medicare Part B premiums, utilities, insurance, and daily expenses, their Social Security isn't quite enough. So, they set up a standard monthly withdrawal from their traditional 401k, totaling $28,000 for the year. They are living completely within their means. But let's do the provisional income math. $18,000 from their Social Security plus the $28,000 they withdrew from their tax-deferred savings. Their combined income is $46,000. They have officially crossed the $44,000 upper threshold. Without making a single extravagant purchase, up to 85% of their Social Security benefits are now exposed to federal income tax. The couple thought they were only paying taxes on the $28,000 they pulled from the 401k. Instead, that withdrawal acted as a trigger. It dragged a massive portion of their Social Security into their taxable income for the year. Financial advisors refer to this specific phenomenon as the tax torpedo. Withdrawing just $1 from a traditional IRA doesn't just add $1 to your taxable income. If that dollar pushes your provisional income over the threshold, it pulls another 85 cents of your Social Security into the taxable column with it. You are effectively being taxed on $1.85 for every dollar you withdraw. This creates an environment where retirees are actively penalized for accessing their own survival funds. If your car breaks down, or you have an unexpected dental bill, and you need to pull an extra $4,000 from your tax-deferred account, you don't just lose the tax on the $4,000. You artificially inflate your provisional income, causing your Social Security taxes to spike alongside it. The most dangerous part of this rule is how quietly it operates. When you file for Social Security, the standard paperwork doesn't highlight provisional income. When you use a basic retirement calculator online, it rarely factors in the exact taxation of your benefits based on your specific withdrawal strategy. Retirees are conditioned to focus almost entirely on the age they claim their benefits. We debate whether to claim at 62, 67, or wait until 70, but we are rarely warned that the source of our supplementary income matters just as much as the age we claim. If the bulk of your life savings is sitting in a traditional 401k, a traditional IRA, or a standard pension, you have a built-in tax liability that you cannot escape. Every standard withdrawal you make to pay for groceries is a taxable event, and under current U.S. guidelines, every one of those taxable events is a direct threat to the net value of your Social Security check. Depending on individual circumstances, some retirees try to adjust on the fly once they realize what is happening. They try to lower their withdrawals. They try to live on less. But the rules can be unforgiving, because while you might be able to control your withdrawals in your 60s, the IRS has another mechanism waiting for you in your 70s, a mechanism that removes your choice entirely and forces the tax torpedo to fire whether you need the money or not. And for many retirees relying on a fixed income, this is where a frustrating tax rule turns into a permanent drain on their financial stability. In your 60s, you still have a margin of control. When you first retire, you manage your tax bracket by carefully choosing when and how much to withdraw from your tax-deferred accounts. If you realize that pulling an extra $10,000 from your traditional 401k is going to trigger taxes on your Social Security, you can simply choose not to do it. You tighten the budget, you delay a home repair, you hold off on buying a new car. You control the flow of your own money to protect your provisional income. But that illusion of control has an expiration date. The IRS does not allow you to keep your money in a tax-deferred shelter forever. They gave you a tax break decades ago when you contributed that money, and eventually, the government requires that tax to be paid. Under current 2026 regulations, when you reach age 73, you lose the ability to dictate your own withdrawal schedule. You are subjected to required minimum distributions, commonly known as RMDs. By federal law, you are forced to withdraw a specific calculated percentage of your traditional IRA and traditional 401k balances every single year, whether you need the money to live on or not. And this is exactly where the tax torpedo transforms from an avoidable mistake into an inescapable mathematical reality for middle-class retirees. Let's trace the mechanics of how a forced withdrawal actively unravels a carefully planned retirement. Imagine you have lived modestly throughout your 60s. You have kept your withdrawals low, keeping your provisional income safely below that frozen $1,984 threshold of $44,000 for a married couple. Your Social Security benefits have been largely tax-free. Then you turn 73. The IRS looks at the balance of your traditional retirement accounts on December 31st of the previous year. Based on your life expectancy factor, they mandate a withdrawal. Let's say your RMD calculation dictates you must pull out $35,000 this year. You might not need $35,000. Your house might be paid off. You might simply want to leave that money in the account to grow, or pass it on to your children. The IRS does not care. If you fail to take the exact required amount, you are hit with an aggressive federal penalty on the money you did not withdraw. So, you take the distribution, you move the $35,000 from your traditional IRA into your checking account. It just sits there. You haven't spent a single dime of it. But on paper, your adjusted gross income has just spiked. When tax season arrives, that forced $35,000 withdrawal is added to half of your Social Security benefit. Instantly, your provisional income shoots past the $44,000 threshold. The government forced you to withdraw your own savings, and by doing so, they automatically triggered the 85% taxation tier on your Social Security. You are now paying taxes on the RMD, and you are paying new, unexpected taxes on the Social Security benefits you rely on for base survival. The money you thought was steadily supporting your retirement is suddenly being funneled back to Washington simply because you reached a specific age. And while this scenario is frustrating for a married couple, there is another layer to this calculation, a deeply emotional reality that the tax code handles with clinical detachment. Financial planners quietly refer to it as the widow's penalty. Retirement planning is almost always done in pairs. You map out your future assuming 2 Social Security checks and a combined tax strategy. But eventually, in almost every marriage, one spouse passes away before the other. The emotional toll is devastating. But in the months that follow, the surviving spouse inevitably runs into a secondary financial shock. When a spouse passes, the household income drops. You are allowed to keep the larger of the 2 Social Security checks, but the smaller check disappears entirely. Logically, you would assume that with a smaller household income, your tax burden would decrease. Under the U.S. tax code, the exact opposite happens. In the year following the loss of your spouse, your filing status changes from married filing jointly to single. Immediately, your standard deduction is cut in half. The tax brackets compress, meaning you hit higher tax rates at much lower income levels. But the most brutal shift happens within the provisional income formula. While your spouse was alive, you were protected by the married threshold. You could have a combined income up to $44,000 before the 85% tax penalty on your Social Security kicked in. As a single surviving spouse, that threshold instantly drops to $34,000. Consider the reality of a 5-year-old widow in 2026. She has just lost her husband. She lost his Social Security check. She still has the exact same property taxes to pay on their suburban home. She still has the same utility bills, the same home maintenance costs, and rising prescription expenses. To make up for the lost Social Security income, she is forced to rely slightly more on the inherited traditional IRA. She is still required to take the RMDs on that account balance. So, she takes her required distribution. Her provisional income crosses $34,000. Because she is now filing as a single taxpayer with a lower threshold, an even larger percentage of her remaining single Social Security check is dragged into the taxable column. She has less total income to live on, yet she is paying a higher percentage of taxes on the benefits she managed to keep. The system heavily taxes her at the exact moment she is most financially and emotionally vulnerable. It is a quiet erosion of wealth. There is no major announcement. There is no warning letter from the Social Security Administration. It just happens in the background, verified by an accountant pointing at the bottom line of a tax return. And the escalation does not stop at federal income tax. The consequences of a forced RMD and a rising provisional income reach much further, impacting the one thing retirees worry about more than taxes: healthcare. If your traditional IRA withdrawals push your income too high, the government doesn't just tax your Social Security. They actively reduce the amount of Social Security you receive before it ever hits your bank account. This happens through a mechanism called IRMAA, the Income-Related Monthly Adjustment Amount. Most retirees pay a standard monthly premium for Medicare Part B, which covers doctor visits, and Medicare Part D, which covers prescriptions. Usually, these premiums are automatically deducted from your monthly Social Security check. You don't even see the transaction. The money just comes out, and you get the net amount. But Medicare premiums are tied directly to your tax return. If a required distribution from your 401k pushes your adjusted gross income above a certain limit, Medicare imposes a surcharge. You are no longer allowed to pay the standard premium. You are forced to pay the IRMAA penalty. Let's look at how this compounds. You take a forced withdrawal from your traditional IRA. You pay standard federal income tax on that withdrawal. Second, the withdrawal increases your provisional income, triggering the tax torpedo, which exposes up to 85% of your Social Security to federal taxes. Third, that same withdrawal pushes your adjusted gross income into the IRMAA bracket. Because of that surcharge, your Medicare Part B and Part D premiums significantly increase. And because Medicare premiums are deducted straight from your Social Security, your net monthly Social Security check physically shrinks. You are taxed more on the benefit, and you receive less of the benefit. All from the exact same action. It creates a spiraling effect that many retirees are entirely unprepared to handle. You map out a budget assuming a set amount of medical costs. But when IRMAA hits, your out-of-pocket expenses for baseline healthcare spike. To cover the sudden gap in your monthly budget, you might have to withdraw even more money from your traditional IRA. Taking out more money just guarantees that your provisional income stays high, which guarantees your Social Security remains fully taxed, which ensures you will continue to be hit with Medicare surcharges the following year. It is a closed loop, a self-feeding financial penalty. When middle-class retirees finally recognize what is happening, the natural reaction is frustration. They did everything right. They followed the conventional advice. For 40 years, financial advisors, employers, and government campaigns told them to put every spare dollar into a tax-deferred 401k. Lower your taxes today, they were told. Worry about it in retirement when you will be in a lower tax bracket. That was the standard American financial promise. But no one mentioned that the tax brackets would compress. No one mentioned that the provisional income thresholds for Social Security would remain frozen in $1984. No one warned them about the widow's penalty, or that taking a required minimum distribution could quietly drain their healthcare benefits through IRMAA. Depending on individual tax situations, the conventional advice to blindly defer all taxes until retirement has slowly morphed into a trap. Millions of retirees sitting at their kitchen tables today are realizing that their tax-deferred accounts are actually joint accounts. They hold the balance, but the IRS controls the distribution schedule and the tax rate. And as the rules currently stand, the more you manage to save in those traditional accounts, the more aggressively your Social Security will be penalized. This realization often leads to a moment of quiet panic if traditional withdrawals trigger the tax torpedo, and RMDs force those withdrawals whether you want them or not. Is there any way to actually protect your fixed income? Many retirees attempt to pivot in their late 60s. They try to move money. They try to reorganize their assets to escape the provisional income formula before the mandatory distributions lock them in. But moving that money requires navigating another set of federal tax rules. And if you execute that maneuver incorrectly, you don't just fail. To escape the tax torpedo, you end up pulling the trigger yourself. When you realize the traditional retirement system is essentially a joint account with the federal government, your first instinct is to try and break the connection. You want to untangle your savings from your Social Security. You want to regain control over your own fixed income before the forced RMDs begin at age 73. And under current U.S. tax law, there is a recognized pathway to do this. It involves shifting your money out of traditional, tax-deferred accounts and moving it into a tax-free shelter. Specifically, a Roth IRA offers a unique defense against the tax torpedo. Unlike traditional withdrawals, qualified distributions from a Roth account are completely tax-free. But more importantly, when the IRA calculates your provisional income to see if your Social Security should be taxed, Roth distributions are entirely ignored. They do not count toward that frozen $44,000 limit. They do not trigger IRMAA surcharges. Once the money is in a Roth, it is effectively invisible to the mechanisms that penalize your Social Security. It sounds like the perfect solution. But getting your money into that safe harbor requires executing a financial maneuver called a Roth conversion. And this is where the theory of tax planning collides with the harsh emotional reality of parting with your money, because the government doesn't let you move those funds for free. To convert money from a traditional 401k to a Roth IRA, you must pay standard federal income tax on every single dollar you move in the exact year you move it. You have to voluntarily write a check to the IRS. This goes against every instinct a retiree has. For 40 years, you were trained to defer taxes. You were conditioned to hold on to every dollar. The idea of taking $20,000 from your traditional savings, paying a few $1,000s in taxes on it right now, just to move it to a different account, feels unnatural. It feels like a loss. Many retirees simply refuse to do it. They look at the upfront tax bill and back away. But financial planners often warn that looking at a single year's tax bill is the wrong way to approach the problem. Because the choice is not between paying taxes and paying no taxes. The choice is about when you pay them and who controls the rate. If you choose not to convert your funds, you are choosing to wait for the IRS to force your hand at age 73 through an RMD. And as we established, that forced withdrawal won't just be taxed as standard income. It will drag up to 85% of your Social Security into the taxable column and potentially trigger Medicare surcharges. By paying a smaller, controlled tax voluntarily today, you are buying insurance against a compounding tax penalty tomorrow. This brings us to a specific window of time that is critical for modern retirement survival. Advisors call it the tax valley. There is a gap between the day they stop working and the day they are forced to take their RMDs at 73. During these years, your earned income drops. You haven't started your mandatory distributions yet. You might even be holding off on claiming Social Security until age 67 or 70. During this tax valley, your adjusted gross income is often at the lowest point it will ever be in your adult life. This is the moment when a calculated Roth conversion strategy becomes incredibly effective. You can slowly shift money out of your traditional IRA, filling up the lower tax brackets year by year. You deliberately pay taxes at a low rate today, permanently removing that money from the provisional income formula so it cannot detonate the tax torpedo later. But this requires precision, because if you panic, if you decide to convert your entire $300 traditional 401k into a Roth account all at once, you will create a massive financial shock. That entire $300 will be added to your income for that single year. You will push yourself into the highest tax brackets. You will maximize your Medicare IRMAA penalty instantly. You will have essentially triggered the exact financial drain you were trying to avoid. Managing this transition requires a scalpel, not a sledgehammer. And because some tax situations may vary significantly, relying on the guidance of a fiduciary tax professional during this window is not just helpful. For most middle-class retirees, it is essential. There is another layer to this strategy, a deeper implication that extends beyond your own lifetime. When you leave money in a traditional tax-deferred account, you are not just deferring your own taxes. You are passing a tax liability down to your children. Under current 2026 regulations following the Secure Act, if your adult children inherit your traditional IRA, they cannot stretch those tax-deferred withdrawals over their entire lifetime like they used to. They are legally required to empty the entire account within 10 years. Think about when children typically inherit money. They are usually in their 40s or 50s, their prime earning years. They are at the absolute peak of their own income tax brackets. When they are forced to withdraw your remaining traditional IRA balance on top of their own salaries, a significant portion of the wealth you spent a lifetime building is instantly surrendered to federal taxes. By strategically converting funds to a Roth IRA during your retirement, you aren't just protecting your Social Security. You are ensuring that whatever is left behind transfers to your family completely tax-free. Understanding these mechanics requires a profound shift in how we view retirement. The old mindset was about accumulation. You saved as much as you could in whatever account your employer offered, and you trusted the math to work out in the end. The survival mindset in 2026 is entirely different. It is about distribution. It is no longer just about how much money you have. It is about where your money is located, how it is categorized by the federal government, and how efficiently you can access it without triggering secondary penalties. There is a quiet grief in realizing that the rules of the game are not entirely in your favor. When you sit at the kitchen table with that SSA 1099 form, staring at a tax bill on the very benefits you worked decades to secure, it feels deeply unfair. The threshold has been frozen since 1984. The provisional income formula actively punishes the middle class. The widow's penalty compresses your limits at your most vulnerable moment. The system operates exactly as it was written, lacking any human nuance or empathy for inflation. But anger won't protect your savings. Resentment won't lower your Medicare premiums. The only defense against a rigid, mechanical system is a calm, tactical awareness of how it functions. You cannot control the 1,984 thresholds. You cannot control the IRS mandate on RMDs. But you can control your awareness. You can analyze your withdrawal strategy before you claim your benefits. You can acknowledge the tax torpedo before it hits your return. Retirement is no longer a passive experience. It requires constant, vigilant management. It means asking difficult questions before the tax year ends, rather than waiting for the accountant's summary in April. It means recognizing that the money sitting in your 401k is not entirely yours, and negotiating the cheapest possible way to buy out the government's share. It is a complex reality, but it is a reality you can navigate as long as you see the invisible lines drawn across your fixed income. Thank you for watching. Navigating these tax rules is incredibly frustrating, and everyone's situation looks a little different. Did anyone ever explain the provisional income rule to you before you retired? Or did you find out about it the hard way during tax season? Share your experience in the comments below. It helps other retirees realize they aren't alone in facing this. Stay informed and take care of your financial future.